All right, good afternoon, everyone. Thank you for taking the time to listen to our presentation today. We are Team Adjacent Starbuckses, and my name is Teresa Rodriguez. I'm joined by my teammates Kyle Graham, Nick Payne, Connor Savage, Duck Chan, and Sam Usdan. During this presentation, first we will provide an introduction to the fund and an overview of the effects of COVID-19. Next, we will discuss our intentions for each sector and answer a few pre-submitted questions. Lastly, we'll do a deep dive into the proposed industrial investment. As investors, you are aware that our flagship strategy aims to deliver returns of 11 to 14% while maintaining a maximum portfolio-wide LTV of 65%. Its $3 billion in assets are divided across 6 different categories as shown at the bottom of this slide. Now I'd like to run through the short and long-term effects of COVID-19 on these sectors. Starting with high-rise office, in the short term, our assets are relatively stable due to the long lease cycles and well-capitalized tenants. That said, we believe that the growing acceptance of remote work will change what high-rise offices look like in the long term. We're expecting to see higher square footage demands per employee and increased TI requests as offices evolve to prioritize meeting spaces and employee safety. For grocery-anchored retail, we've proven to remain resilient due to the superior performance of grocery, which makes up 50% of our total square footage. That said, food and beverage operators have continued to struggle as an effect of this crisis in the short term due to capacity constraints. Long term, we expect the need to re-tenant food and beverage operators that can't stay afloat, but believe that activity will return to previous levels. As other segments of retail continue to weaken, it will become beneficial that most of our non-grocery space is focused on food and beverage. Industrial has been positively affected by the change in consumer needs during COVID-19 as more people have turned to e-commerce. As a result, the demand for distribution and fulfillment centers has increased. In the long term, we believe that economic shifts will change what assets carry the most value as competition increases and tenant demands change. For urban multifamily, COVID-19 has left many individuals and families leaving cities for the suburbs in search for more space. While this has caused a negative demand shock in the short term, we fundamentally believe that people will always be drawn to cities for the amenities and overall lifestyle. Long term, we expect to see a higher emphasis on home office spaces and outdoor amenities. Workforce housing has remained relatively stable during the COVID-19 crisis since essential workers make up a large percentage of the residents. Growth to date has been focused in secondary markets due to the ability to provide more space at a lower cost of living. Long term, we expect positive growth to continue in this sector. And lastly, while our non-traditional assets make up the smallest percentage of our portfolio, they offer unique opportunities. Life science was already seeing positive growth before this crisis, and the surge of investments in R&D has only increased this trend. Long term, we believe the sector will continue to perform, even with an increase in competition. Data centers have positively benefited as the surge of remote work has increased demand for web-enabled services. Long term, we don't believe this trend will continue though. Many companies plan to build and operate their own data centers, and we predict that the use of space will become more efficient. For single-family housing, it's been one of the big winners coming out of this crisis. Somewhat surprisingly, home prices have increased nationwide, but rents have remained relatively stable. Long term, we believe that single-family housing can be most successful in Sunbelt cities, research centers, and Western secondary markets. And lastly, self-storage has been relatively unaffected by this crisis, and we don't expect any long-term implications. The need for space exists both when the economy is weak and people are downsizing, and when it is strong and people have more disposable income. So with that, I'll hand it off to Sam to discuss where we expect valuations to land as a result of these trends.
Thank you. My team believes that our portfolio will be adversely impacted in the short term, but that we will be able to meet our long-term forecasted targets. Our urban high-rise office and multifamily portfolio may see a 20% hit to its mark-to-market valuation. Post-vaccine, behavior will not completely revert. However, the changes will be net neutral or positive for our portfolio. As Gen Z graduates college and enters the workforce, they will agglomerate to the vibrant urban environment that city centers offer. The trend of increasing office density will inevitably reverse. More firms will transition to program space and individual enclosed workstations that minimize cross-employee exposure. We will have fewer tenants in our buildings, but each tenant will rent more space. Grocery-anchored retail will remain flat, and our industrial portfolio will increase by up to 20%, given demand placed on our logistics infrastructure by increased e-commerce and medical activity. Workforce housing and non-traditional sectors will appreciate by 5%, in the short term, and life sciences will prove to outperform in the near and long term. Now, Kyle will speak to our future portfolio.
Thank you, Sam. Currently, high-rise office makes up the largest portion of our portfolio, but it is one of our most underperforming assets. Because of this, we intend to reduce its presence in our portfolio and redeploy our capital elsewhere. To do this, we will opportunistically sell some of our assets with well-credited tenants or long weighted average lease terms, where we think that we can find prices with minimal discounts. Overall, we are bearish on high-rise offices in primary markets. We believe that net rent will fall and base rent will stay flat, while operating expenses rise as tenants request additional COVID-related improvements. Because of this, we will seek opportunities in other asset classes and in locations where Class A office supply is tighter, such as CBDs and growing metro areas. Our grocery-anchored retail portfolio will likely weather the effects of COVID and hold its value into the future. Because of this, we expect that our assets' value will return following COVID's resolution once our locations find new tenants to replace any COVID-related business failures. In industrial properties, our intent is twofold. We would like our portfolio to remain desirable to ideal tenants operating in the space. However, our portfolio is 8 years old on average and is no longer keeping up with the demands of Class A space. Because of this, we intend to sell our older properties now, as they are likely at the top of the market value, and we will be able to get the optimal value for these assets. From here, we intend to both buy and build Class A assets in last mile fulfillment and cold storage, because these kinds of properties will allow us to differentiate our portfolio, command higher rents, and secure larger returns. For this strategy, we intend to target last mile fulfillment in large metro areas with spatial constraints, and cold storage in locations with growing importance in grocery delivery and pharmaceutical deployment. In urban multifamily, we believe strongly that the desire to live in cities will return with the resolution of COVID. In the near term, we suggest making some small improvements to our properties to make them more appealing to work from home situations. This will help us continue lease up and cover our debt payments. Longer term, we think that the sector will continue to provide value, so we will dedicate some efforts to pursuing opportunities in space-limited secondary markets. Within workforce housing, we foresee excellent opportunities to extend our position and find returns. Our research shows that there is currently a large migration of blue-collar jobs to the southern portion of the United States. Our intent is to capture the demand for Class B properties by focusing our efforts in secondary markets with growing job centers. This would be predominantly a value-add strategy, with our fund focusing on properties that can be repositioned to solid Class Bs, where we are confident that we would see high cash flows and low volatility. Finally, our team believes that there are numerous opportunities in alternative assets. Firstly, we believe that we should sell our data center asset, as it is likely at the top of the market, and we will foresee user demand shifting away from leasing third-party provided space in the future. Next, we see growing levels of investment in life science as an enormous opportunity. We intend to invest in this sector in primary markets where there has been minimal capacity growth relative to the demand. In single-family housing, we see an opportunity to take advantage of growing demand in middle-ring suburbs and transit-oriented areas. We would seek a joint venture with a more experienced partner to develop and operate a growing portfolio of properties once the prices come down, following overvaluation due to COVID. Finally, we predict that self-storage will be stable in the future, providing consistent cash flows and growth opportunities in areas with growing residential populations. Now, Sam will summarize our intentions with our portfolio.
Thank you. As we consider the future of our portfolio, we see significant opportunities through reallocation of capital across geographies and asset classes. We plan to reduce our office portfolio by 1/4, selling the stabilized tech tenant-heavy assets that will inevitably depreciate due to their disproportionate exposure to hybrid business models in the next leasing cycle. We intend to reinvest proceeds into secondary central business districts that will experience higher growth next cycle. We will keep our retail and urban multifamily portfolios constant, with necessary CapEx to maintain market relevance. We will sell our older industrial stock that does not meet the exacting specifications of newer e-commerce and logistics tenants. Current market dynamics will drive favorable returns on these assets. We will replace them with Class A cold storage and last mile fulfillment properties that will continue to see demand through the next cycle. This change will have an outsized impact on our long-term returns, despite the modest increase in sector distribution value. We aim to increase our workforce housing portfolio by 1/3 by purchasing transportation-oriented assets proximal to new industrial development that are conducive to value-add improvements. Our alternative sector portfolio will see a roughly 50% increase in size, with a larger emphasis placed on life sciences and single-family residential. Our total portfolio size will increase by 1% with the addition of a proposed development, which we will discuss later. Now, Nick will address LP concerns.
Thank you, Sam. In the next 3 slides, I'd like to go over a few specific questions from our limited partners. The first is around political risk. Based on polling for runoff elections, we currently think that we will likely face a divided government next year with a Democratic president and a Republican Senate. First, I will highlight a few of the main effects we expect from this outcome. Overall, we expect most of the status quo to remain the same, as the Republican Senate will block the more liberal policy initiatives of a Biden administration. One area we expect changes is reduced tariffs on Western countries, which will reduce construction costs due to current tariffs on Canadian lumber imports and European steel imports. However, increased infrastructure spending is also expected, which would have the opposite effect on raw materials. Finally, an emphasis on healthcare spending from the Biden administration could have a benefit for life sciences. Now, in the unlikely event of a Democratic Senate after a runoff and a united government, a few additional factors would apply. First, we would expect a looser immigration policy, which would positively impact multifamily. Second, there could be an increase in capital gains taxes, which could increase volatility with more frequent buying and selling of assets, as well as reduce the value of many real estate assets due to decreased demand. Finally, any environmental mandates and regulations could reduce the value of office and other commercial real estate if they were required to retrofit solutions. Despite this political uncertainty, fundamentals will still drive most of the real estate value, and we recommend taking a value-based approach to real estate investment decisions. Now, on the topic of future geographic focus, for us, it depends on asset type. We consider primary markets to be resilient long-term due to high barriers to entry, but there will be pain in the short term, which is why we are targeting these strategies as we have previously discussed. Now, for secondary and tertiary markets, people were moving to these markets before COVID due to millennials having kids, a search for more space, and housing affordability. COVID has only increased this trend. That's why we are targeting housing and other sectors with positive supply-demand dynamics in these markets. As far as contrarian bets go, we are looking to sell items that are currently in fashion to take advantage of high market pricing, but where we see potential pricing drop-off in the future. These include data centers, Class B industrial, and opportunistic multifamily, where the current strength of the credit tenants can create demand for buyers in these scenarios. On the buy side, we are looking at residential and following long-term demographic trends to take advantage, long-term demographic trends for the country, as well as taking advantage of current market opportunities, which could include distressed hotels with the potential change of use as we look for a long recovery from the COVID crisis. We are also open to using new tech to enhance returns on these strategies, such as modular construction for new workforce or single-family rental development. I will now pass it off to Duck to introduce the pipeline.
Thank you, Nick. Moving on, we have a new investment opportunity that we want to share with you today. This new opportunity is an industrial development that fits squarely within our fund strategy to relocate assets within the industrial sector. The new development will be a grade A quality asset, and we expect a property level IRR of 13.3% and an LP level IRR of 11.6%. The new investment will contribute 3% to our portfolio allocation. Moving on, we are showing you more details on this development. We are looking to partner with a reputable industrial developer who has an option on the ground lease on this site, and we expect to develop 3 properties for a total of 1 million net rentable square feet. We believe that this investment allows us to take advantage of the very strong fundamentals in the industrial market, despite a potential weakness in the ground lease that we will touch on later on. We look to mitigate our development risks by engaging in a sponsor with a strong track record. And we believe that this investment will become a trophy asset and generate strong demand from tenants looking for high-spec properties. As an indication for our demand in our property, we have already received a pre-release offer. However, as this offer is below market, we opt to turn it down and continue our leasing efforts, with a strong conviction that we will be able to get a better rent for the project as comparable to the market. We take a conservative stand in underwriting the rents at a slightly below market comps trended to the project delivery date. Moving on, in terms of the proposed partnership terms, the GP will contribute 10% of the equity, while we contribute 90% of the equity. They will have a 40% profit participation after a 9% preferred returns, but in return, the GP will provide all the guarantee for the construction. We believe that these terms are consistent with our fund goals and provide alignment between parties. Also, we recognize that there are potential for negotiate better new terms, taking into consideration of the change driven by COVID and how demand for industrial property has risen. At this stage, we feel it's prudent to underwrite this opportunity with the new term SC. Now, Connor will discuss the number and assumption of the deal with details.
Thanks, Doug. For purposes of modeling this investment opportunity, we have underwritten a business plan consistent with our sponsor. Development is intended to take place over 15 months after execution of a PSA and JV agreement for an $83 million total budget with a max price contract for the hard and soft costs. 65% of the unlevered budget is assumed to be financed by a construction loan with a 4.7% interest rate. Stabilization and lease up is assumed to take place over a 9-month period. To reiterate, Duck, we have assumed blended rents of $4.63 per square foot and blended TIs and LCs of $8.70 with 3 months of free rent. Rents are assumed to be triple net with tenants reimbursing all operating expenses and the ground rent. Upon stabilization, we have assumed a 6-month operating period to provide cushion for a sales process, which will culminate a 30-month investment period with the disposition for an exit cap of 5%, which we will discuss in further detail over the next 2 slides. Given the ground lease, short hold, and sensitivity of returns to the exit, we paid particular attention to our residual value assumption. Ultimately, we landed on a 5% cap rate, which implies a per pound exit of $91 per square foot in nominal dollars, or an inflation-adjusted $86 per square foot today. Compared to sales comps 3 and 4, which were also on ground leases, both of these assumptions felt appropriate. We believe that there will be a deep and liquid market for this asset at sale. The buyer will most likely be either an industrial REIT or a private investment firm. Although the former may have a bit of heartache regarding the ground lease, given the property type and quality, this should hopefully prove to be a non-issue. Rolling all of the assumptions into the model, the underwriting implies total profit to the project of $9 million, a levered IRR of 13.3%, a 1.3 times equity multiple on a total equity investment of 28.7. Taking into account partnership economics of a 40% promote over a 9% pref, Catskill, the fund, is projected to earn an 11.6% levered IRR and a 1.3 times equity multiple after paying out roughly $1.3 million in promote to our sponsor. Given the max price contract we will sign with the contractor, the tight submarket dynamics to drive leasing velocity, and the guarantees provided by the sponsor, we feel the biggest risks are face rent and exit. As such, we have provided a sensitivity on rent and exit cap showing project level levered IRRs. We feel our rents are appropriately conservative and could see significant upside. If we are able to push blended rents by just 20 cents a foot, levered returns could exceed 18%, which would significantly outperform our fund goals. In summary, we feel that the investment isn't sufficiently de-risked given partnership alignment and shovel-ready status of design and entitlements, has base case returns that are in line with fund targets and investment goals, and ultimately has upside potential to outperform given both macro and micro tailwinds in the industrial sector and submarket. As such, we recommend investing in this new project. Sam, take us home.
Thank you. In conclusion, we believe that reallocation is necessary to mitigate risks and ensure future capital appreciation for our investors. Although we expect a temporary downward shock to our portfolio valuation due to COVID, we believe that the changing market presents us with opportunities. To seize these opportunities, we need liquidity. This will require us to exit some assets at lower than forecasted cap rates to recover equity and avoid breaching LP leverage covenants. We listen to our investors and our investors' needs. We will pursue opportunistic, strategic, and often contrarian investments that satisfy investor demand for stable near-term cash flows while creating long-term value. Additionally, we recommend moving forward with the proposed investment, which aligns with our overarching industrial portfolio strategy. On behalf of my team, thank you for taking the time to listen to our presentation. Now, we'd like to open the floor for questions.
And John, do you have
Do
any
you guys
comments?
worry at all about selling office at the bottom and buying life science at the top?
Answer any questions either now or offline at a later time.
Yes, so one of the things that we're doing when selling office is we're trying to sell our highest quality assets. So that would be our assets with our highest credit tenants and our longest weighted average leases. So we believe that we will be able to sell them with a limited discount. As for life science, we see that while it is a highly valued market now, it will only tend to increase in value in the future, as there has been substantial investment in the space in the VC area and in many cities.
I'll add one other note on that. As Kyle was talking to, we're going to definitely be opportunistic in selling our office assets in order to reduce that discount, as well as we have concerns. There's certainly uncertainty right now, but we have concerns post-COVID if those assets are necessarily at the bottom of a downturn now. When those leases roll, if we're not able to get the same 5-year weighted average lease term or lower rent, then we could actually see some further depreciation in those assets. So we think where they are currently, we could actually save some value compared to where they might be in 3 to 5 years.
Yeah, the assets that we're looking to sell are predominantly tech heavy, and those are going to be the ones that are disproportionately exposed to hybrid work models. So we're confident they're going to downsize space.
I have a question for you. Regarding the new investment opportunity. You mentioned that there was a pre-lease opportunity and you turned it down in favor of leasing up the existing building leasing up the new building. Could you talk through the difference in economics between the two scenarios, please?
Yes. So the pre-lease opportunities that we are given, although it was a grade A tenant with a very strong credit rating, we believe that it was way below the market rent that we can achieve looking at the recent transactions of our nearby comps. So we believe that although with a pre-lease opportunity we can save up on the leasing time and get more certainty in this project. Ultimately, we have a strong conviction that this project is a great asset that will be able to generate sufficient demand from our other leasing tenants, and the fact that we generate high good rents will be able to translate it into better returns, and that is a more material assumption for our underwriting.
And also, just to speak to the changes in overall IRR, if we're looking at the largest space at 375, which is what they offered versus what we are projecting, you're looking at an unlevered return that goes all the way down to 1.7%, at which point we wouldn't recommend moving forward on the investment. So we think they kind of tossed in a lowball offer, hoping that someone's just looking for that secure tenant up front. But given where the comps are, we feel confident in where we could find other tenants to fill that large space.
Yeah, I think further building on Nick's point, just moving that one tenant space by face rent by 10 cents, the overall levered returns could drop by up to 250 basis points. Whereas if we just delayed leasing by 3 months, returns only move by about 50 basis points. So in our perspective, focusing on face rent was much more important to our overall returns.
Your portfolio return range is 11 to 14. And so 14 ought to be for the highest risk, the opportunistic. And the 11 should be kind of, core-ish, core plus, right? Your returns here are 11.9, which seem to be at the low end for a higher risk opportunity. How did you get comfortable with that?
I think one way that we got comfortable with that, and looking at this slide, we took a close look at the market and we maybe were a little bit too conservative in setting our rents, but we feel very confident in them. When you look at the market comps in the third column, over 250K square feet, their starting rents are at 420, but they all have about a 2.3% annual escalation when you blend them together. So when you trend those to our delivery date, you're looking at rents that tenants in the market will be paying is close to 440, whereas we're projecting our rents at 430. So we're being maybe excessively conservative. So it's a great question. I think that the way we've gotten comfortable with it is de-risking both our starting rents, the GMP contract, having the sponsor take on the risk of completion guarantees. So when we look at this overall, we feel very comfortable that we've de-risked it in relation to maybe other more opportunistic development opportunities.
Thank you. It's great presentation. Thanks.
With regards to the partnership returns, this is what you settled on what they originally proposed. It would seem to me that they're only investing 10% and that, and then they're taking, after the preferred 9, they're taking 40%. That seems pretty aggressive. And I was thinking, get your thoughts, they're out of extensions on this. So you do have some leverage with regards to maybe going back to them. Was that a consideration?
I'll let Connor speak a little bit more to some of the analysis we did around that in terms of how it could affect our returns. I think that we modeled it in this way because we were looking at it from, if the industrial market is improving, could there be other equity sources lined up? But it's an excellent point that they're out of extensions and we could leverage that for our own benefit in terms of how the deal is set up. We would probably also pitch it not only a lower profit participation, maybe come back with 20% to them, but also try to stagger the profit participation depending on IRR hurdles. Right now, it's just one hurdle after the 9% preferred return. We'd prefer to see that as something more in the 10 to 20% profit participation, maybe up to a 15% IRR, and then beyond that, maybe getting higher in order to further align incentives. But we wanted to look at it the most conservative way possible, given that it's a hot market right now, so there could be other equity sources.
Yeah, just building upon Nick's point, we really wanted to focus and ground our underwriting and not try and get too aggressive, recognizing there might be leverage coming up at some point. But with that said, even in our base case underwriting, we had projected paying them a $1.2 million promote, which in the grand scheme of things felt like a pretty fair sort of aggregate sort of excess profit participation to the sponsor. Had we, moved our hurdle down to 25% or, lowered our hurdle down to 25% or raised this, the pref rate or decrease, whatever it might be, the overall movement in profit, that additional participation they would receive was anywhere from, roughly $200,000. And in the grand scheme of things, as a way to sort of enter this market with a, sort of secure shovel-ready site, we felt like the $200,000 may just be small dollars in the grand scheme of things and didn't want to get hung up on that for purposes of an initial base case underwriting.
Thank you.
All right, you've got about 30 seconds left. So if there's any quick questions to ask, I would do so now.
Maybe let us know how you're planning to deal with your near-term and immediate-term debt maturities on your high-rise portfolio, particularly given that you've told us you think the values are down 20%, and presumably so do your lenders.
That's part of the reason why we're exiting portions of that portfolio, to pay down the debt and make sure that we don't breach our leverage covenant.
And in addition to that, we'll also, while we're taking a conservative case on the value here, we'll definitely be pitching the rosiest scenario to our lenders as we refinance that near-term debt. So we're hoping that they will take a less bearish view. But we think with some sales of high-rise, we should have enough liquidity to pay down some of that debt, like Sam was saying, in order to be in a hot water scenario with some of that near-term debt.
Thank you.
Great job.
Thank you.
Hello, everyone, and thank you for taking the time to join us today. It's no surprise that 2020 will go down in history for many things. One of those being an acceleration of certain trends that benefited some sectors in real estate and punished others. My name is Blair Evans, and I am an LP consultant facilitating this meeting between Catskill Capital Partners and their LPAC. Today, I have gathered Catskill's team leads. We will hear from Kyle Rains, Chris Gordon, Charles Lehman, David Brown Dawson, and Adam Dominic. This evergreen real estate fund currently sits at 1.35 billion net asset value and aims for stable 11 to 14% IRR returns. Catskill exercises discipline to pursue opportunities that support the mission of all of their LPs here today, many of which are representing endowments of universities from all across the country. As the fund grows and the investing environment changes, Catskill remains dedicated to be your stewards of capital. But we are living in a world confronted with uncertainties, and we as the LPs have many questions. So I have collected those questions today, and Catskill will answer them by sharing their insights and go-forward strategies. Catskill uses a rational decision-making framework grounded in long-term perspective to ensure a strong portfolio through euphoric, but also turbulent market cycles. So how exactly do they do this? Well, they have evaluated the current portfolio, updating valuations and recapitalizing so that they can capture stable growth through sector rotation. One of those sector rotations is into industrial, where they are pursuing a JV development consisting of 1 million rentable square feet across 3 industrial buildings. With conservative underwriting and a 4-year hold-in period, this investment would achieve the fund's return goals. But before we get into the details of this strategic plan, I want to hear from Catskill's chief economist to provide some clarity on what is going on in this market.
Great. Yeah, Blair, let's kick it off by addressing the elephant in the room. COVID-19 plunged the US economy into a deep recession, with GDP falling by historic rates in 2020. As lockdowns loosened, employment growth resumed, and GDP began a swift recovery. We foresee GDP returning to pre-COVID levels by Q3 2021. But the real estate industry's recovery will lag that of the broader economy. But I wouldn't be a good economist if I gave you a clear takeaway without a few caveats. As you can see on the graph on the right, the unemployment rate has continued to improve in recent months. This trend line is deceptive though, as the unemployment rate is a lagging indicator of economic conditions, and the current massive nationwide spike in COVID infections will likely cause this positive momentum to reverse. The pandemic has weighed heavily on commercial real estate investment activity. With valuations and longevity of current macro trends so uncertain, investors have decided to park their capital on the sidelines, resulting in a decreased investment volume of 44% year over year so far in 2020. Meanwhile, the Fed plans to keep interest rates near zero until 2023, which will likely translate into greater downward pressure on cap rates, supporting a hold and refinance strategy, despite tightening underwriting standards. But I might have my PhD revoked if I talked about monetary policy without mentioning fiscal policy too. So as the control of the Senate is still up in the air, the incoming administration's ability to fully implement their agenda is in question. If the remaining races go Democrats' way, their plan would be to raise taxes and introduce about $5.4 trillion in stimulus and other spending in the economy over the next 10 years. Several real estate sectors stand to benefit from that spending, including industrial, which would be boosted by the sizable infrastructure spending. And it's no secret that real estate is underperforming in this economy, with these major asset classes suffering immensely as a result of urban flight and work from home trends. There are pockets of growth in non-traditional assets. The bottom line is that this unusual recession has resulted in a bifurcation, creating a barbell of performance within the real estate industry and creating opportunities for savvy investors.
Thanks for that context, Kyle. So how do these trends impact CAT-scale portfolios specifically?
Blair, that is a great question. Before diving in, I'm going to review our process and portfolio management strategy, as well as what we'd like to achieve with our recommendation. Then I'll follow the roadmap on this slide. The goal of our process is to position the portfolio to take advantage of long-term trends discussed earlier, while also lowering the cost of our debt and increasing flexibility through refinancing. Finally, we do not want to be forced sellers in this current market environment due to poor market activity. We would rather hold on to our assets and weather the storm. As mentioned earlier, we are an evergreen fund that focuses on high-quality assets both in coastal and suburban areas that will provide strong risk-adjusted returns. We target an 11 to 14% IRR with a max 65% portfolio leverage and a 10% cap on development. Digging a bit deeper into our current portfolio, we can see that we have a fund level leverage of about 55%, which is well within our target. Now, needless to say, COVID has caused significant economic uncertainty, and the real estate valuations in our portfolio need to reflect that. To do so, we turn to the public markets for guidance and use public REITs as a proxy. Public markets are forward-looking and will provide guidelines of how values are expected to change. As you can see, traditional asset classes have lagged while non-traditional asset classes have outperformed. While we turn to the public REITs for guidance, we did not apply the returns directly. Instead, we adjusted the returns slightly to reflect the higher quality and superior location of our assets. This results in a portfolio NAV that is marked down by about 8%, which is approximately 50% of the public market proxy. Blair, does this make sense so far?
Yes, so you updated the portfolio to reflect current valuations, but what does this do for our debt?
As usual, you're ahead of the game. Here's a side-by-side comparison of the portfolio before COVID and the portfolio today. This shows a greater weighting to industrial and non-traditional assets, while office and urban multifamily have decreased. You will note leverage levels changing from 55 to 57% due to the decrease in NAV. Next, due to the appreciation in value of industrial non-traditional assets, we have the opportunity to refinance and rebalance the portfolio. Doing so frees up approximately $200 million in value and allows us to lower leverage levels and extend financing on depreciated assets, mainly office and workforce housing. Finally, we will also look to extend the term on grocery retail without changing the capitalization. This results in a portfolio with lower interest expense, increased cash levels, and extended debt terms without having to sell any assets at depressed prices.
Okay, so if I'm following correctly, the rebalance allocation has an increase in cash. So what do we do with that cash?
Yep, that's correct, and is a good point. Now that we have extra cash and solid debt structures, we can look to be opportunistic and even contrarian. On the slide, you can see our conviction views for each property type sorted from highest to lowest. To start, we believe non-traditional will excel as the need for data storage and self-storage continues to grow with the 5G and urban flight trends. We also believe industrial will continue to see strength as well. The Amazon effect and last mile trends are definitely here to stay. Now, workforce housing is one of our contrarian bets. We expect strong rent growth going forward as people continue to leave expensive cities in search of more space and safety in secondary and tertiary markets. Relative to urban multifamily, there is plenty of upside in rents here. Grocery has been one of the few bright spots in retail. We think this will continue while other retail such as food and beverage operators will experience a slower recovery over time. Now, office is another one of our contrarian bets. We have a lot of peers that are currently selling out office, but we think there's an opportunity as smaller companies switch to work from home model and larger blue chip companies acquire more office space. Now, finally, urban multifamily has been disrupted as COVID and social unrest in primary cities has caused many residents, both old and young, to leave in search of more space and affordable, safer communities. We see this trend continuing, and while we are not bullish, we will not sell these assets as they are still in their lease-up phase. Once stabilized, we will then look to refinance. Now, to round it all up, here's the new target allocation. The key takeaway here is the increase in leverage and positioning due to slight sector rotations to industrial, non-traditional, and workforce housing. If executed, this new portfolio will be positioned to take advantage of long-term trends. We'll have improved cost efficiencies due to timely refinancing, and we'll have increased flexibility due to higher cash levels.
Okay, I'm happy to see that this portfolio has been de-risked and there's some flexibility. You mentioned an increased allocation of industrials. Charles, can you explain what exactly is the opportunity here for Catskill?
Absolutely. So the proposed development comprises 3 assets in an institutional non-port market. One is a bulk distribution, which is exactly what the name implies, while the other 2 are shallow bay, which are smaller assets, more suitable for last mile delivery. All 3 are fully entitled, with 32-foot clear heights and 190-foot truck courts. These aren't quite at the cutting edge of industrial trends, but are solid assets. So e-commerce, which is the key tailwind of industrial demand, has accelerated during COVID and is approaching 20% of all retail sales. Online retail requires 3 times more space than equivalent brick and mortar, which explains the positive absorption and rent growth in 2020. So industrial was defensive this year. Rent collection, delinquency rates, and transaction volumes have all outperformed the other major property types. All right, so logistics broadly falls into 4 buckets. We've sorted them here based in descending order on their distance from the final delivery and their size. Our assets can be broadly categorized as multi-market. So it's important to understand that this asset class is about more than just the shell. It's about understanding the logistics and operations inside the building. So think of bulk warehouse and shallow bay as the hubs and spokes of logistics. The defining characteristic of industrial is its clear height, which refers to literally how much stuff you can stack. So the bare minimum for bulk and shallow bay are 28 and 24-foot ceilings respectively. So clear height is based off rack height, and rack height is just how many cases you can stack. 64 inches is the most common case height. That means that a 36-foot clear height gives you a whole extra case. So we're discussing with the developer why they decided on a 32-foot clear height, given that Amazon's 4th generation warehouses require 70-foot clear heights. Now, with that said, these specifications aren't too far off market. Another rule of thumb is that bulk distribution assets are generally 250 to 500,000 square feet. Our shallow bay assets are also right on the money here at 175,000 square feet. So we're happy with the exterior dimensions of this building. And another key factor is the truck court. So at the risk of bringing up traumatic memories from high school geometry, a truck court is real estate speak for the literal turning radius in the parking lot. This drives how many 18-wheelers can be moving around in front of a building at any given time. And both of our assets are fine here at 190-foot truck court. So accommodating larger trucks is critical because 3/4 of US goods by value are delivered by truck. Now, I'm not going to get too into the weeds here, but cross-docked assets let you flow goods directly between trucks, which are parked on opposite sides of the warehouse. And rear-loaded is only one way and is more for long-term storage. And rail loading means literally having your warehouse adjacent to the train tracks. This isn't super common, but it could be more attractive in this submarket, given that it's non-port and certain tenants might be shipping or storing larger goods than trucks can handle. So in summary, we have a good mix here. A cross-dock bulk distribution asset is generally more attractive than a rear-loaded one, but there is known market demand for both types. So to summarize, while both of these assets are competitive, they're not necessarily highly differentiated in the current market. But my colleague David has just finished his MBA strategy class and cannot wait to talk you through a SWOT analysis. David, what are we seeing?
Thanks, Charles. As part of the business plan, we'll look at a SWOT analysis, and then I'll go over our pre-lease strategy for the 3 spaces. We have an accessible site in a desirable location that is fully entitled and a GMP contract that will limit our construction costs. These attributes, along with our pre-leasing strategy, have taken a lot of development risks off the table and limited our downside. As far as weaknesses, although the GMP executes post-close, we're confident in our development partner and the contingencies in our budget. Now, typically we would prefer to buy the land, but the ground lease doesn't encumber the deal with higher expenses. In dollars, it's costing about the same as paying property taxes. And institutional capital has accepted deals with similar ground leases. The phase 2 opportunity increases the marketability of the investment, both to prospective tenants looking for future expansion opportunities and buyers looking for a value-add, diversified industrial asset. There are evolving demands of industrial tenants, which Charles mentioned. These threats have informed our decision for a short hold period of less than 4 years, limiting our need to predict too far into the future. We believe rewards outweigh the risks, and we have been able to strategically mitigate many of the risks. Because of uncertainty in the longevity of the industrial cycle, evolving industrial standards, and an expanding submarket, we decided to remove risk for our LPs and pursue a pre-lease strategy for 2 of the 3 spaces. We plan to rent 650,000 square feet, the 650,000 square foot space to a credit e-commerce tenant, but would like to negotiate the terms to be more in line with the market. We like the long 120-month lease term, as that leaves 6 years on the lease when we exit, which is important to our marketability at sale. We are willing to give up the comparable market rents for this long-term lease and realize the rear-loaded dock may be less desirable than a more flexible cross-dock building. Thus, that was shown in our comps. We feel that the $395 per square foot rent is more reasonable than what was proposed. Also, as income is responsible for so little of our return in this deal, we want to lower our TI costs in favor of giving up more in rent abatements. We will also pre-lease our rail space, as the market for this asset is thin and unpredictable. But with over 82% of the asset pre-leased, we feel confident in the demand for the cross-dock space, and we'll take that to market to try to get more aggressive terms. In closing, the SWOT analysis shows that it's a strong investment with mitigable risks, and pre-leasing takes some of that risk off the table.
Okay, I agree with this strategy, but let's cut to the chase. What are the returns?
Of course, Blair. We're underwriting to a 13% IRR for our fund and building to a return on cost of 5.5%. We ran a variety of scenarios to arrive at our business plan from a return standpoint. We initially underwrote the investment with the pre-lease terms as initially proposed by the bulk tenant, but we couldn't quite in good faith move forward with this proposal as it failed to deliver at least an 11% IRR. The second scenario involved rejecting the pre-lease opportunity and going to the market on the bulk space in an attempt to secure higher rents. This scenario does underwrite, at least on paper, to a higher return of 13.2%, but ultimately we view the 13% IRR in our negotiated pre-lease scenario as really the best risk-adjusted option, given that we're locking in rents for the vast majority of the space. From both a levered and unlevered cash flow standpoint, the key takeaway here is that most of the cash distribution comes through the sale of the property in year 4. Now, after building our model, we wanted to take a step back and ask ourselves an important question. Is it really worth all the extra gray hair and the headache of pursuing development when we can more easily buy existing industrial assets today? And the answer is yes. We have the opportunity to build brand new product at $80 per square foot, whereas recent comps are trading in a range, but upwards of $110 per square foot. We take this as a sign that industrial product may be trading at above replacement cost, which we view as an argument for pursuing development today. In addition, our asset will generate a 5.5% return on cost, leading to an 80 basis point spread over our projected exit cap rate of 4.7%. The spread may be a little bit on the tight end, but ultimately we're okay with it given the lower risk involved with a pre-leasing strategy. With respect to sensitivities, our project is highly sensitive to exit cap rate, vacancy, and starting rents. With respect to exit timing, while we are underwriting to a 4-year hold, we'll be very dialed into local market conditions to determine whether an earlier sale upon stabilization may be more prudent. With respect to financing the project, we did have the option to pursue a pari passu funding option. We actually decided to go with the equity first funding option, even though, at least on the margin, it's a slightly lower return. But funding equity first enables us to avoid recourse to the fund, which really better protects our LP's precious capital. But getting our JV terms right is very critical to us. With respect to the split of distributions, we've countered with a multi-tiered hurdle structure, whereby the operator will receive 30% of distributions above a 9% preferred return and 50% of distributions only above a 14% IRR. The structure really incentivizes our operator to deliver a best-in-class project such that we beat our underwriting. Just to conclude on a few additional considerations. We propose that our developer is responsible for any cost overruns up until their development fee of 3%. And then a key issue to us is exit. Our general philosophy on exit is to create a solution that ensures that both parties are very committed to the deal, but also allowing enough flexibility to exit at the appropriate time. So we propose a liquidity lockout until construction is complete. And after that time, either party can exit the deal subject to a right of first offer. Now, overall, we believe this deal has many merits.
I just got an alert about a promising new vaccine. What does this mean for Catskill's strategy?
You know, Blair, we actually considered that in our analysis and portfolio construction and still believe that our portfolio is slated to outperform due to prevailing trends in industrial and non-traditional asset classes.
Great. Well, that is reassuring. Thank you, team, for answering all of the LP questions by walking us through your newly evaluated portfolio and this promising industrial opportunity. I would now like to open it up to see if there are any other questions.
Great, thank you, Manzanita Capital. Judges, if you have any questions, please feel free to unmute yourselves.
Well done. Thanks for that presentation. You had a 4.7 cap rate at the end of your industrial opportunity. Can you help us understand how you got comfortable with that? It didn't look like from the comps that we could assume a sub 5 cap.
So yeah, no problem, Adam. Happy to take that one. So overall, we didn't feel like any one comp was really a great match for our deal. Really, the comps are kind of all over the place. A few considerations we took into account was timing of the exit, whether there's ground leases or no ground leases, remaining lease term, any portfolio sales. Kind of what we saw was that before COVID, the cap rates were trading around 5% plus or minus. And then since COVID has occurred, cap rates are kind of more in the mid 4% range. We think that comp 1 is probably a little bit too low, given that there's longer lease term on that ground lease. And then comp 2 is probably also a little on the lower end too, given that there's a tax abatement. So we felt that 4.7%, although it's still on the lower end relative to kind of the COVID comps, we felt that it was still slightly above the other ones we saw. And then a final thing just to mention really quick is this phase 2 option. We believe that that's very valuable to any future buyer, and we believe that they might pay up for that future option.
And I'll just quickly throw in that the last comp that was north of 5%, the Treasury, 10-year Treasury was about 200 basis points higher when that was done.
On a basis point, what's the ground lease as far as being detrimental to the exit cap?
I'm happy to take this one. When we looking at the ground lease, we considered it quantitatively and qualitatively. So quantitatively being how much the annual rent is, which was actually on par with the property taxes on stabilized industrial products in this market submarket. And then qualitatively, we looked at the timing. So it's a 40-year ground lease with no extension, and our hold period is only 4 years. So we really were not concerned about coming up to that expiration date. And also we saw that this was a ground lease is pretty common in this submarket compared to our, when we're looking at our comps. And then also one other thing we considered is just how fast the technology is advancing in this space. So given in 40 years, this product might look very different. And for the future owners, they might either want to convert this product into something else that would be more, it wouldn't be obsolete at that point. So we believe that our 4-year hold period is actually really solid, and the risks that come up with a ground lease were not a deal breaker for this opportunity.
Thank you.
Is there any other questions from the judges?
Blair asked all my questions.
All right.
I'd like to talk about the pre-lease for a second. You're making an assumption that you'll get the terms, the counter terms that you're proposing. Let's assume for a second you don't get those. What's your recommendation then?
Yeah, we actually looked at that. We did a sensitivity around that that rate, and we would still move forward even if we got closer to like the 3.8 range. We still hit our 11% minimum for the fund, so we would still want to move forward with pre-leasing that to take the risk off the table, but are willing to give up a little bit of the rate if the tenant were to push back.
Any other questions?
Well, thank you. I'll share my screen.
We will start the timer whenever you're ready.
Okay, good afternoon and welcome to the Q4 investor presentation. I'm Chairwoman Megan Armlin, and this presentation will be given by Teddy Swift, Head of Research, Griff Rogan, Chief Fund Manager, Ahmed Hajjad, Head of Strategy, Zach Mandel, Chief Investment Officer, and Santiago Mayoral, Head of Underwriting. To guide our discussion today, we will start by covering U.S. politics, then move to the influences of the pandemic on the market. We'll present an overview of the fund structure, expectations for Q4, as well as changes we are making to the fund. We have an investment opportunity to present, a Class A industrial complex positioned to us by a developer with exciting promises. Finally, the future of the fund and closing remarks. And now for the State of the Union. We've all been watching the news, and here are the things we've been seeing. First and foremost, we see a Democratic presidency and the likelihood of a split government with a Democratic House and Republican Senate. This is a strong indicator of stability and bipartisanship on key issues, including the stimulus package and economic relief. We believe a stimulus package should be passed by Congress and dispersed in Q1 of 2021. The House is pushing for a $2.2 trillion stimulus. However, we see the results being closer to $1 trillion. This is enough to keep economic recovery, but not enough to put an upward pressure on the market in the long term. Equally prevalent has been the promising developments of the vaccine by Pfizer and Moderna. We expect the product should be licensed as soon as Christmas and distributed in Q2 and Q3 of 2021. This should help bring business, tenants, and work back to significant capacity within the next 2 years. So what does this mean for us? We are an evergreen fund. We have no pressure to act reactively, but will continue to be proactive in our strategy. We are well capitalized with open access to financing sources. We are a resilient investment vehicle with a diversified portfolio in robust markets. And we continue to maintain our strong partnerships with our operators and developers through these uncertain times. We're cautiously optimistic. We've not seen the end to the global pandemic, but the trends we are seeing are hopeful and will continue to be vigilant for what's coming next. So how are we acting on this? We start with the macro fundamentals, doing industry-leading research and staying ahead of trends such as the flight to quality to ensure sustainable growth. And we have high conviction strategies. We seek actionable opportunity to strengthen our diversified income stream. And we focus on durable yields, ensuring appropriate risk-adjusted returns and long-term appreciation focused on our evergreen fund. And with that, I'll turn it over to Teddy Swift, Head of Research.
Thank you very much, Megan. I'm going to walk you through a recap of what has been an incredibly long 9 months, and then give you our view of the market moving forward. We saw in the spring a massive supply-side shock. Non-essential services were forced shut, people stayed in, people mostly saved. And despite a bounce back since then, we're going to see GDP contraction on the year of around 4%. What spending that did occur in the spring was concentrated in essentials such as groceries and through e-commerce. Urban areas have been hit especially hard. The cost-benefit calculus has shifted for a lot of people, as companies are offering work from home and the amenities that attract people to cities are toned down. And then these changes happened within the span of weeks. And the capital markets mostly shut down as the finance world was waiting for the dust to settle. As a result of this uncertainty, we saw significant social unrest that continues today to a lesser degree. So how will the dust settle? Focusing on the areas that could fundamentally change our view of the industry, we want to zero in on work from home and the move out of cities. And starting with the urban exodus, we expect that trend to revert in the short term. For a lot of people who are on the verge of moving to the suburbs, we think this acted as a kick out the door of sorts. But as the convenience and amenities that come with city living come back online, we expect people to follow. The stickiness of the work from home trend is harder to predict. We get the sense through conversations with our operators and tenants that the honeymoon period is over. Employees are burning out. I know I am. Productivity is about equal, but efficiency is way down. So we expect employees will choose to go to the office because they want to. So we do expect it to come back, but does it come back to 100 and how soon? Ultimately, we think yes, but timing will depend on the industry. Tech, we expect to take a bit longer. We see their culture is better suited to work from home. Banking, financial services, advertisement, we expect to come back near and full as soon as the pandemic subsides. And now looking forward, there's a lot in the market's favor. As Megan said, we expect expansionary fiscal and monetary policy to continue. The banking system is mostly well capitalized with over $3 billion in reserves and full support from the Fed. This will allow banks to offer forbearance on loans. Properties with any sort of positive net cash flow will likely avoid foreclosure, and therefore there will be limited stress in the marketplace. So then marry that lack of distress in the marketplace with an all-time high of dry powder on the sidelines. We really don't at all expect a market-wide reprice like we saw coming out of the GFC. And without that significant distress in the marketplace and so much capital chasing what there is, we don't see today's environment as a time for big contrarian bets. I would say our biggest contrarian take is that gateway cities bounce back in full in the medium term. But even then, we don't foresee many buying opportunities for now, given the liquidity in the marketplace. The investment opportunities we do see in the short to medium term are in secondary markets where the supply-demand dynamics favor rent growth. Things are changing quickly though. So we want to make sure to keep an eye on indicators to stress test our outlook. Namely, we're going to be watching how people migrate, and we'll be watching the balance sheet of banks, especially those community and mid-sized lenders. So now to touch on how our fund fits within our view of the market, I'm going to toss it over to our Chief Fund Manager, Griff.
Great, thank you, Teddy. Our fund has consistently produced above market returns by diversifying among major niche asset classes in strong markets on conservatively leveraged deals. This aversion to unnecessary exposure has helped us to weather periods of market uncertainty in the past and will continue to ensure consistent gains in long-term value. At the end of Q4 2019, our portfolio had a strong mix of high-quality assets in major markets across all asset types. Our total portfolio value was $3 billion, of which 45% was contributed equity, while the additional 55% is financed by debt. High-rise office in New York City and San Francisco was our largest exposure at 36% of portfolio, with 3 assets in New York City and 1 in San Francisco. None of our other asset types accounted for greater than 20% of overall value. As you can see, we were well positioned at the end of 2019 to capitalize on continued trends in 2020, but then in March, the US became affected by the pandemic. 2020 has been a dramatic year in commercial real estate, and here are some of the macro trends that affect asset classes we are invested in. Multifamily vacancy rose in coastal cities, especially New York City and San Francisco. Retail continued on its negative downward trend, with the exception of grocery-anchored retail, which continues to be the one bright spot in the market and has seen increase in demand. Non-traditional assets, including life science, data centers, self-storage, and single-family rentals, all reached new highs in value and demand due to impacts from the pandemic and an increasingly digital economy. E-commerce continues to usurp market share from retail, reaching an all-time high in May of 2020, accounting for 20% of the retail landscape. We estimate the underperformance of our major urban metro properties to be a short-term problem, as the majority of our asset classes are located in premium New York City submarkets, which we are confident will be the first areas to return once the pandemic is under control. In the intermediate, value growth in complementary sectors will supplement our overall portfolio. Additionally, during 2020, we began to address the upcoming debt maturities of our high-rise office product and grocery-anchored retail centers. We believe in the value of our assets based upon the mix of tenants and the strength of our market locations, which should alleviate concerns about refinancing $650 million within 12 months and an additional $900 million of portfolio value in 12 to 24 months. With the impact of the pandemic, some of our properties were affected by asset level value shifts. Urban multifamily and high-rise office were the 2 most negatively impacted asset classes that we hold, with an estimated 3 to 8% decrease in asset values. The impact of these decreases were mitigated, however, by the performance of other asset classes we possess in our portfolio, including workforce housing, industrial, and non-traditional. We expect these trends to continue as e-commerce assumes a larger part of the retail void and as life science, data centers, and self-storage grow in demand nationally. As you can see above, based on the strength of the assets we own, there is minimal difference in our asset value allocations, and our implied equity in the portfolio only decreased by 100 basis points. Our largest exposure to debt concerns remains in the office sector. After our reevaluation, our existing loan to value is 62.5%. We think this diversified portfolio will only continue to serve us better as we look to reposition our exposure slightly in 2021. Next, I will give it to Ahmed, who will walk you through our projected repositioning plan.
Good afternoon. So Megan and Teddy have discussed what we've seen around us, and Griff has now quantified and shown where we're most likely to stand at the end of this quarter. So now let's look at how we'll reposition ourselves and forge ahead along a slightly altered trail. As always, we are led by our goals to deliver a diversified income stream and to hold assets that yield income growth and growth in the medium term. With the trends in office life and given the opportunities we've seen elsewhere, we want to downsize our exposure here. Our grocery anchored retail investments are relatively small, and with the strengths of our anchor tenants in mind, we don't see a need to change our fund allocation here. Our urban multifamily investments underperformed this year, but as we said, we believe in the long-term appeal of urban city life, and so we think there'll be a rebound. So we're going to hold out. We're not going to add to this asset class, but we're not going to decrease this also. Our workforce housing portfolio serves the true heroes of what has been a tumultuous year: healthcare and service sector workers. It's also seen solid performance in our fund, which we think will continue, and thus we want to add some more assets here. Our non-traditional consists of data centers and life science centers, which are heavily in demand. Spurred on by the gains that we're seeing and the persistent opportunities, we think this is a great space to expand our exposure. We'll come back to industrial in a bit. So how exactly do we intend to reallocate our funds? First, we want to decrease our high-rise office exposure by roughly 25%. We think the capital that we gain over there can be better allocated to other assets. We'll use the proceeds of that to increase our workforce housing by 9% and other non-traditional assets by 55%. In addition to that, as Griff and Teddy touched on earlier, industrial has been the big winner of the year, and we expect this to continue as companies reconfigure and onshore their supply chains. While more industrial space is being built now than ever before, demand is still outpacing supply and rents continue to rise. We want to increase our industrial portfolio by 18% over the next year. This will make it, along with high-rise offices, our main asset class investment. Now keep that play in mind as I hand over to Zach.
Thanks, Ahmed. Given our objective to re-optimize the portfolio, Catskill has been working diligently to put this strategy into action. And as a result of our efforts, I'm excited to present to you our first investment opportunity. This will begin our initiative to redistribute capital from our office holdings into ventures that yield higher returns. We are proposing the opportunity to partner on the development of a 1 million square foot infill industrial complex. This complex is comprised of 3 buildings and is propelled by strong market fundamentals. We expect the 15-month development to yield approximately $4 million in net income annually once stabilized. And given the return-centric nature of the deal, we expect to exit 4 years after delivery. Catskill believes that the deal benefits from a number of attributes that warrant investment. The asset is already entitled, the ground lease effectively finances the land cost, strong market fundamentals, including both the scarcity of new stock and consumer trend tailwinds, support the asset's appeal. And the potential for a phase 2 provides expansion optionality for either us or prospective buyers. Additionally, the potential partnership with a strong industrial developer who has already dedicated significant capital into firming up the deal substantiates our conviction in the investment. However, like all investments, risks are inherent in the deal, the majority of which is centered around the ground lease. The relatively short term of the ground lease upon disposition and the lack of extension options impacts the terminal value by adding uncertainty to the forecasted cap rate compression at exit. In response to this risk, our underwriting team has conducted extensive stress testing and are confident in the project's viability. Beyond the advantages of the investment discussed above, the most important thing about the project is in its alignment with the fund's overall repositioning strategy. Investing in industrial, a defensive and resilient asset class, allows the fund to realize accretive returns utilizing the redeployed capital from our pivot program. In addition, the proposed development abides by all stipulated fund requirements and caps. Now, Santiago will take us through the investment financials.
Thanks, Zach. It's great to see all our limited partners here. Thank you again for your trust. Before I start, I just want to take a minute for us to remember that our underwriting approach is geared towards providing an acute and precise evaluation of our investments, contrasting each assumption to real-world data points and market confirmation. And in that line, with regards to the investment opportunity, we did some scouting in the market and obtained what we call a shadow offer for the anchorage of the asset for us to identify a baseline for our assumptions. A baseline that we anticipate can be improved significantly due to thriving demand for industrial asset class. This way, while we got a competitive offer from a potential tenant, we estimate we would be able to lease the anchorage of the asset at a rent price that could be up to 15% higher than that of the shadow offer, with significant less abatements. The improvement supports Catskill's return profile, positioning it within the 11 to 14% range targeted by the nature of our fund. So now let's speak about cash flow generation. We estimate that the 80 million investment opportunity will generate a 4 million stabilized NOI, translated into a 8.2% unlevered IRR, and, as anticipated before, a 12% IRR to Catskill's equity investment. It is important to note that these return metrics are consistent with a significantly conservative approach geared towards applying a rigorous underwriting evaluation given the current risk environment. In addition, we estimate these returns will be derived from what we call an optimal waterfall structure, on which a preferred return and a promote will incentivize the operator to outperform. Importantly, even though initial capital structure and promote dynamics were discussed with the operator, based on our enhanced underwriting approach due to higher risk premiums from COVID-19 uncertainty, our fund decided to shift the waterfall structure to a 10% preferred and a 20% promote. This way, operators' projected IRR remains strong at almost 16%, an attractive level given the current real estate environment. Now, turning into investment risks and how to mitigate them. The two major risks we anticipate are, first, the lease fundamentals being impacted from higher quality product, and second, disposition risk given that our thesis, as Zach mentioned, is predicated on a 4-year ground lease. Regarding the first risk, we anticipate low likelihood for lease fundamentals to negatively impact our thesis, given thriving demand for the asset class and its potential strengthening for the future. With respect to the disposition risk, even though at the moment of sale, our ground lease would have less than 35 years remaining, and that would potentially be reflected on higher exit cap rates, our underwriting is based in significantly conservative assumptions that do not take into account any potential cap rate compression from the attractiveness of industrial assets in the future. Quantifying these risks, we decided to build up a sensitivity analysis running our model through different levels of stress, yielding us to the conclusion that rent prices and disposition cap rates could be the largest risk levers. A 7% drop in rent prices from the $4.17 per square foot, which, by the way, would position rent for our assets significantly below the entire comp set, would represent a 200 basis points decrease on our 12% IRR. In a similar way, a cap rate expansion of 35 basis points would impact in a similar way our returns. Taking into account these stressed scenarios, our IRR would be between 9 and 10% after full impact, which we estimate it's still higher than Catskill's cost of capital. I will leave Zach to guide us on the main conclusion of the investment opportunity.
To sum up, today, Catskill has a solid and attractive investment opportunity in its hands. An opportunity that not only helps diversify our portfolio, but also an investment generating compelling returns in a favorable and defensive asset class operated by a credible and experienced developer. We strongly recommend this investment opportunity and see it as a catalyst for long-term value generation to our fund.
Thank you, presenters. As we look forward to the future of the fund, we want to reiterate a few important points. The Fed is supporting economic policies, and the coronavirus vaccine will be licensed and distributed shortly. We continue to invest in strong markets, and we target durable yields to provide long-term and stable returns. We thank you for your time and being with us today. We wish you and your loved ones safety as we head into the holiday season. We're now open for questions.
Thank you so much. Judges, if you have questions, please feel free to unmute.
Regarding the new portfolio allocation, you had an increase on the
Yes.
non-traditional.
Yes.
5%.
55%.
What would the target be for data centers, and then separately what for life science?
Would probably split that 50% and 50%, but it will depend on the opportunities that come available to us over the next year.
Thank you.
Any other questions from the judges?
I like your sensitivity analysis, but I wonder whether just a 7% drop in rents is really sensitive enough for the downside. A lot of us that have been through some cycles know that rents can drop more than 7%.
Yes, thank you for your question. You're right, although you have to bear in mind that our rent per square foot, which is $4.17, it's already 5% below that of the comp set. So a 7% additional drop to rents would imply almost a 13% drop in rents for entire, if we compare our asset to the comp set. So that said, we believe it's a fair stressed out scenario given the current attractiveness of the asset going forward.
Thank you.
Any other questions?
Good afternoon, everyone, and thank you for joining the Q4 2020 Limited Partner Meeting for Catskill Capital Partners. My name is Caroline O'Neill, and I'm joined today by my colleagues Will Barrett, John Blizzard, and Connor Monahan. Since the onset of COVID-19, our team has prioritized communication with our capital partners, and we're glad to have the opportunity to speak with you today. The primary goal of this meeting is to share details on the overall impact of COVID-19 on our existing investments and how we see the pandemic shaping our allocation strategy going forward. We will also spend a fair amount of time discussing a current investment opportunity as an example of the types of deals that we are seeing in the market today, and we'll save time at the end of the presentation for questions. I'll hand it over to Connor Monahan to discuss portfolio performance.
Thank you, Caroline. So it's no secret that COVID has had a severe impact on markets, good or bad, especially in real estate. When we look at our portfolio, there have been some clear winners and losers. We have seen a decrease in our high-rise office assets, as well as our grocery-anchored tenant assets. Our multifamily portfolio has also declined due to increased concessions, despite cap rates holding flat as investor demand for high-quality assets has increased. Lastly, industrial, as well as our alternative assets, have been the bright spot of the fund. In terms of methodology to arrive at the adjusted valuations, we looked at COVID's impact on both operations and the cap rates. Where available, we use private market cap rates, but for some asset classes with limited private market price discovery, we use public REIT valuations to understand the impact of COVID on the valuation. And taken all together, our gross asset value has decreased by 5% and equity value by 13%. So where do we go from here? As you can see from the exhibit at the top of the page, pre-COVID, we had strong conviction on industrial, workforce housing, and alternative assets. What has changed is our view on high-rise office and grocery-anchored assets. While we all know that grocery stores have fared pretty well during this crisis, what particularly hasn't fared well is the food and beverage operators that occupy some of the space. There's been little price discovery as it relates to our retail assets, as few private market transactions have occurred during the third quarter. While well-located, needs-based retail continues to be perceived as somewhat COVID resilient and is still of interest to some buyers, the sector has proved difficult to underwrite. We expect that COVID will pull forward several years of retail fallout, which will continue to negatively impact the assets. Near term, our strategy is to avoid any liquidation of assets at distressed levels, as well as increase our allocation to development from 5 to 10%, recognizing that valuation of already existing assets in high conviction sectors like industrial is extremely high. I'll now turn it over to Will to go over our debt maturity profile.
Thanks, Connor. Capital markets are available to sponsors who possess strong balance sheets and quality assets like the ones Catskills own. We continue to finance and refinance our investments at attractive prices given where base rates are. Our near-term debt maturities are largely concentrated in our retail assets, and this does give us some concern as we've seen upticks in credit loss and reductions in percentage rents. As we examine each loan relative to the value of the asset, we believe there continues to be equity value. However, we may be required to call capital and pay down the debt on select assets to levels that lenders deem appropriate. Our retail assets are difficult for lenders to operate, so in a worst case scenario, we expect that we'll be able to restructure the debt and remain in place as the operator. We believe that we can monetize favored assets at higher post-COVID valuations and use the equity raised from sales to pay down our near-term debt and avoid liquidating at distressed prices. We believe it to be prudent to use proceeds from asset sales to shore up our credit profile as opposed to satisfy redemption requests, as that would severely impair the value of our portfolio.
Long-term, our allocation will look like the exhibit at the top of the page. Just to go over some areas where we see the biggest changes, high-rise office will move to 10% from 33% post-COVID or pre-COVID. We believe that there's a consensus that the 5-day office work week is not likely to persist, and markets reliant on public transportation will experience slower recovery, like the gateway markets. Additionally, industrial will take the largest portion of the portfolio going forward. We believe tenant demand is strong and will remain that way post-COVID as buyers have shifted towards e-commerce and tenants seek to increase space to hold safety stock for supply chain concerns. Lastly, other non-traditional assets will move to 25%. Single-family rentals, life sciences, and data centers, we believe represent a good relative value play and are expected to realize increased demand and investment going forward. And we'd also like to thank the LPAC for their questions prior to the presentation, and we'd like to address some of those concerns that came out in those questions. Starting with the 2020 election. While it did create some uncertainty, long-term, we don't feel like there's a significant impact on the portfolio.
And as it relates to select market opportunities, we continue to have disciplined market selection and will consider investment opportunities in both gateway and secondary markets. We believe that investments in gateway cities improves liquidity through downturns and that we can continue to achieve attractive yields in smaller MSAs. While the outbound migration from major markets has largely benefited the Sun Belt, we see a tremendous contrarian opportunity in New York City. In the years leading up to COVID, we've seen many first-time buyers who've never experienced a downturn acquire buildings and land at a high cost basis and with high leverage. This, coupled with changes to rent regulation, stalled neighborhood-wide rezonings, and now COVID, provide an opportunity to identify well-located assets at an attractive basis. And as Caroline previously mentioned, we wanted to discuss a new investment opportunity that we're currently evaluating. We've recently identified an attractive investment opportunity consistent with our target allocation and in line with our required returns. We've had the opportunity to invest alongside a best-in-class industrial sponsor who currently has control of an as-of-right 1 million buildable square foot industrial development site located within a premier urban infill submarket. The contemplated development consists of a 650,000 square foot rear-loaded bulk distribution facility and two 175,000 square foot shallow bay warehouse buildings. And we have identified a credit tenant willing to pre-lease the bulk facility on a 10-year lease. Interestingly, the land is owned by a city-affiliated entity who is extending a 40-year ground lease. The all-in cost basis of $79 per gross square foot compares favorably to recent industrial sales, which have consistently traded in the 100 to 110 per gross square foot range. With the project level levered returns at 45% and with the approximately 89 basis point spread from spot cap rates to stabilized yield, we believe that we're appropriately compensated for and have priced in the development risk. Since 2016, our house view has been an optimistic one as it relates to the logistics market opportunity. Post-COVID, we're even more bullish. To provide some color on recent sector tailwinds, we want to share the following statistics. April to May 2020 e-commerce sales were 7% higher than during the 2019 holiday season. And the US e-commerce penetration rate experienced 10 years of growth in 3 months, according to McKinsey. This is evidenced by my grandma, who can barely open her flip phone, who now orders her groceries online, drives her station wagon to the store, and has a stranger load them in the trunk. We believe many of these sector tailwinds to continue. And now I'll pass it to Caroline, who will speak about the strengths of the submarket.
Thanks, Will. There are a few characteristics that make this specific industrial submarket attractive to our team, most important of which is the fact that demand is significantly outpacing supply. So the total submarket is roughly 57 million square feet. And in 2020, there has been about 5.9 million square feet of net absorption, leading to an overall occupancy gain of roughly 10.4%. All the recent deliveries in the submarket have been leased within 6 months or less, and the current submarket occupancy is 99.3%, which is a key consideration for the next buyer and one that we believe will really help us achieve a premium on exit. Moving to our underwriting, we relied heavily on those submarket fundamentals to inform our assumptions and want to highlight a few specifics about our base case. As mentioned, our operating partner has secured an LOI with a credit tenant for the bulk distribution building, and our base case assumption assumes that this LOI is converted to a lease. Due to the prospective tenant's credit profile and based on initial conversations with lenders in the market, we've underwritten a lower blended interest rate of roughly 4.05%. We also adjusted the hold period from 4 years to 2 years. And while we recognize that this is somewhat of a quick turnaround for development, we believe it's reasonable given that the site is fully entitled. We also assumed a 15-month development period, whereas bulk industrial generally takes around 8 months for vertical development, leaving a conservative 7 or so months for design and any other pre-development items. Furthermore, by taking the pre-lease credit tenant that we've mentioned, we have about 65% of the space already occupied, leaving leasing brokers to focus on the remaining shallow bay space in a market that has extremely tight vacancy and strong demand. And finally, given the triple net lease structure of the leases and the fact that the majority of the square footage is leased to a credit tenant, the next buyer would have clarity on the revenue and operating expenses as compared to other asset classes. And we believe that this shortened development time horizon is reasonable and it creates value for all parties involved. It increases the net IRR to the fund, improves the promote and liquidity for the developer, and also adds 2 years to the ground lease for the next buyer. Over the next couple of slides, we'll dive deeper into a few of the key underwriting assumptions. First, on the rental rates, we looked to recent market leases as a basis for our assumptions. For the bulk distribution building, the rental rate of the prospective credit tenant is $3.75 per square foot, which is about 12% below the comp average that you'll see on the top half of the screen, and about 8% below the largest lease, which was signed for 706,000 square feet. Admittedly, our to-be-built building has lower ceiling heights and will not have cross docks, so this discount to market comps may be warranted. And further, we are comfortable with the relative discount due to the cost savings on other aspects of the project generated by the pre-lease, including the favorable interest rate that we mentioned and less downtime post-construction completion. On the bottom half of the page, and for the shallow bay buildings, we underwrote a rental rate of $5.50 per square foot, which is about a 7% premium to recent lease comps, which we feel is warranted given the tight vacancy in the submarket and increased demand. These buildings will be the highest quality product in the submarket at delivery, with 32-foot clear heights and rail access for one building. And I'll hand it to John to discuss sales comps.
Thanks, Caroline. The sales comps indicate since the onset of COVID, we've seen cap rate compression of approximately 50 basis points from around 5% to 4.5%, compared to our assumed blended exit cap rate of 4.45%. Our exit cap assumes a 4% on the pre-leased credit tenant space and a 5% cap rate on the non-credit shallow bay buildings. From a basis perspective, the all-in cost base is $79 per square foot, and our max estimated sale value of $96 per square foot compares favorably to recent sales comps averaging $103 per square foot. In particular, we wanted to highlight Comp 3 and Comp 4 as highly relevant. Both have a ground lease with 38 years remaining, and they show the market valuation for a credit versus a non-credit tenant. So here the market shows a credit spread of 40 basis points with a 5.4% cap rate for the non-credit tenant and a 5% cap rate for the credit tenant. At first glance, our assumed exit cap rate of 4.45% may seem below market. However, there are two critical factors we want to highlight. The first is both these sales comps took place pre-COVID, and as we've seen, cap rates have compressed 50 basis points in this market, in line with cap rate compression we've seen at a national level for industrial. The other thing we wanted to point out is that Comp 3 with the credit tenant has below market rent escalations, and this has a huge impact on the valuation. So if you look at the middle right exhibit, we ran a sensitivity analysis showing that if rent escalations are 1% below market, that would inflate the cap rate at exit by 82 basis points due to the impact that the lower rent escalation has on the present value of the cash flows for the remaining ground lease term. So looking at the bottom exhibit, after accounting for these adjustments, we believe that a non-credit ground lease cap rate is the market showing about a 5% exit cap, and a credit tenant ground lease, the market showing a cap rate of approximately 4% in line with our assumptions. However, it is important to note that the 40-year ground lease creates a value constraint on the investment relative to a fee simple transaction, and the finite 40-year life of the ground lease does limit the effectiveness of the cap rate as a valuation tool. So given this, we believe the present value of the remaining cash flows over the ground lease is what will underpin the sale price to the next buyer. So on the previous slide, we demonstrated the market has valued similar ground lease transactions on an indicated cap rate of 4.45%. But we wanted to go a step further and essentially prove this out by conducting a valuation from the perspective of the next probable buyer, which will likely be an industrial REIT. So assuming a 65% renewal probability and some market renewal terms, we built out the cash flow for the remaining 38 years of the ground lease. And then we discounted this by a 5.25% discount rate relative to an average weighted average cost of capital that's 46 basis points above the industrial REITs. So we believe the spread is conservative due to the credit tenant, the strength of the market, and the strong access. But at this discount rate of 5.25%, we calculated a REIT would be willing to pay $91.4 million for the asset, resulting in a net 34.5% IRR to the fund. And this scenario serves as the base case of our valuation range. So another item we considered was whether to pre-lease the credit tenant at $3.75 per square foot or to build spec for a rent of around $4 per square foot. Despite the lower rent, we found that the pre-lease scenario to a credit tenant was accretive, and we felt it improved the risk reward profile of the deal. So compared to a speculative development, the pre-lease scenario shows a higher development spread at 89 basis points, despite less lease-up risk due to the lower cap rate assigned to the credit tenant. Looking at the base case, which again is driven by the present value of the cash flows, the pre-lease scenario had a higher IRR at 34.5% due to a lower discount rate, again, due to lower credit risk. And then finally, the upside in the pre-lease credit tenant scenario is far superior to the speculative non-credit tenant scenario based on the sales comps we've been seeing in the market. So pulling this all together, we come to a real strength of this transaction, which is the compelling upside, downside, and flexibility at exit. So our base case assumes a REIT buyer at exit values the present value of the remaining 38-year ground lease cash flows at a 5.25% discount rate, resulting in a 34.5% IRR and a 1.34x MOIC. This valuation relative to the exit NOI indicates a cap rate of 4.68%. But as we've shown, we believe sales comps indicate a 4.45 exit cap rate is achievable. And we believe this scenario reflects the upside, potentially a higher valuation a private buyer would be willing to pay using leverage via an assumable, fully amortizing 25-year loan. So in this upside scenario, we have an IRR of 46.6% and a 1.47x MOIC. And then finally, if we can't find the optimal buyer for this development, there is an option to hold the investment through the 40-year ground lease term and still meet the fund return requirements with an 11.4% IRR. And with that, I'll hand it off to Caroline.
Thanks, John. In the final build to hold scenario, we assume a cash out refinance at the end of year 2 based on a 70% loan to value, and we're using forward 12-month NOI and a 4.45% market cap rate. This results in a loan of roughly $67 million and an equity cash out of about $16 million, which is 59% of the equity. It's important to note that this is a fully amortizing 25-year loan. And as we think about the lending market and as lenders struggle with underperforming hotel, retail, and senior housing loans, we believe that there will be an appetite for fully funded loans backed by credit tenants and desirable asset classes with significant lease term remaining, despite the ground lease structure.
Thanks, Caroline. We're really excited about this opportunity, but it's not without its risks. However, we believe they've been identified and we can appropriately mitigate them. To account for supply chain capacity and potential redesign risk, we're carrying reasonable contingencies and escalating hard costs. We're also confident in our construction budget based on feedback from GCs who are active builders of industrial product in the submarket. As it relates to lease-up risk, we believe that underwritten rents are in line with the market and product type. And we've also significantly de-risked the project by committing to a 10-year lease with a credit tenant. We also believe that the lease commitment has allowed lenders to get comfortable providing an unsubordinated leasehold mortgage at 65% LTC. Despite the ground lease structure, we believe that the long-term contractual cash flows and risk profile of the development have construction lenders less concerned about being taken out by permanent financing. The biggest risk is associated with the exit. The ground lease structure and remaining term will naturally put off some buyers. The lower for longer interest rate environment provides an attractive yield spread between industrial cap rates and the 10-year treasury. Whether the next buyer is a REIT or a private investor placing an assumable, fully amortizing loan on the property, we believe the cash flow and risk profile to be an attractive one. And as Caroline previously mentioned, there's an option to cash out refinance, returning capital to investors and generating an attractive cash on cash for the duration of the ground lease. Finally, we believe that the irreplaceable infill location and tight submarket vacancy will largely insulate the development from any concerns about new supply. With that, I'll pass it off to Caroline for discussions around sensitivities.
Thanks, Will. As Will and John both discussed, the largest risk to the returns here is the exit. And so we ran various sensitivity analyses, and in our downside scenario, we assume a 75 basis point expansion in the discount rate. And in that scenario, the project would still achieve a 10.2% net IRR to the LPs. While we recognize that this is a low return profile for development deals, we feel that it is a reasonable downside, and it's only 80 basis points lower than our target returns. One other point to note is sensitivity as it relates to hold period. If construction, lease up, or sale takes longer than expected and the hold period is extended to 4 years, the net IRR to LPs is 15.4%, which is above our target returns. Now to highlight a few details of the proposed 90-10 JV structure. As it relates to the promote, prior to COVID, the operating partner proposed a 40% promote. However, we believe that we have negotiating power in this situation to counter with a 30% promote, as the ground lease is in its final extension period and the operator is really motivated to secure an equity partner. This adjustment also reduces profit dilution to a level that's more in line with our overall fund target. So one other item to highlight in the structure is the synthetic sale mechanism. If we choose the build and hold strategy that John discussed, the operating partner will likely want to crystallize their promote. So we have structured in a synthetic sale mechanism to buy out the developer. And that brings us to the end of our prepared remarks. We really appreciate your support of and trust in our management team. We are confident in our team's abilities to manage through this period of uncertainty and believe that our diversified portfolio is well positioned for success over the coming years. And we'll now open it up to any questions that you may have.
Thank you so much. That was great. Judges, do you have any questions for the team?
Just one on my side. I really like your decision not to sell the retail and the office at a time when everybody else is selling them. But I do wonder a little bit about your long-term goal of 35% being an industrial or a diversified fund.
Yeah, thank you for the question. So one thing to note with industrial is that currently our allocation is at 37%. So it is a slight reduction from current levels. In terms of the diversification, you're right, that is quite a substantial investment in one asset class. But I think looking at the convictions that we have for the various asset classes out there in terms of long-term demand and those fundamentals, that's where we see the best opportunity.
Thank you. Well done.
Bradley, great job. What are you most concerned about on this industrial investment opportunity?
I would say we're most concerned. We've talked about the complications from the ground lease, and that we think that the value for the next buyer is going to be underpinned by the present value of the remaining term. So we think we've been conservative with the 5.25% discount rate relative to the industrial REIT weighted average cost of capital. but the returns are very sensitive to that discount rate. Again, we think that we've seen some sales comps that have supported even higher valuations, but I think that's the highest concern because the build to hold, I think, is a potential fallback, but we're not 100% certain in the fact that the lending market is there, although we are confident. And so that's probably the highest risk to this, is that we're going to see a higher discount rate than we've underwritten.
And just to add to that, we think the buyer universe for is essentially taking on a ground lease with no reversion cash flow in the medium or long term is somewhat small. So as John said, it's just identifying who the next buyer is and value constraints around the ground lease.
Any other